We think the markets are incredibly resilient right now, and we think much of that is based upon the sentiment coming out of earnings season, the calls that are going on, and despite some of the information and reports coming out on inflation, producer price inflation yesterday, which is still running hot, consumer price inflation running hot, we heard last week, companies are still communicating that they're able to pass along these price increases to their customers. So we think even though we've seen a decline this year, S&P down about 6.5%, and certainly the growth indices down even more, we think there's still an underlying theme of overall optimism if we can get through some of these more challenging times right now as it relates to monetary policy and the inflation front.
What feels appropriate for you when considering Fed policy? It seems as if the market could be bracing for anywhere between 4 and 7 hikes when it comes to interest rates in the near future over the next year or so. What do you think is appropriate to help tame inflation?
We think they're on the right path, and we think that this more marked and slow process is working, and yet they're in a very delicate balance right now in terms of going too far, too fast. And I think that's really where the market starts to get a bit of heartburn around what the next amount will be. We are confident there will continue to be increases over the course of the year, but really not going too fast. And so I think it's a very delicate balancing act, and one that we think that the Fed is prepared for, but it's really around how quickly they go and not sending us over the precipice, if you will.
With all of that in mind, what is your best investment strategy right now as investors are trying to get a handle on risk and on inflation, potentially with some hedges in their portfolio?
We think that investors still need to be overweight equities. We think that despite some of the concerns regarding inflation, regarding monetary policy, that you're still getting paid to be in risk assets. And compare that to bonds, where we see rising interest rates. We see a bond index that's down over 4% year to date. It's a challenging time to be a bond investor. And just layer onto that the flattening of the yield curve that we've seen. And it makes it really challenging to generate the types of returns that are needed for most investors. Now, as a friend's grandmother used to say, we're not going to have a pity party about this, but we think that really you need to focus on adding to equities despite some of the weakness here, and wanting to really capture the growth and the returns in that over the coming year, despite some of the noise that's out there in the marketplace and around policy.